Novo Nordisk just dropped a bombshell with its guidance for 2026. So let's take a look if the company is a buy at current levels. But before we jump into projections, let's first see how well our expectations from the previous video were in line with Novo Nordisk's actual numbers. What we can see here in green is that Novo Nordisk over-delivered on almost every single promise in 2025, with EBITDA and free cash flow, which are very important for our stock price calculations, were underestimated even on our highest assumptions, meaning we underestimated the stock price across the board. Now let's take a quick look where 2025 actually sits to companies' best. What we see here is again great numbers with revenue growth at 16%, with gross margins being at 82%. The last time they're being so low was in 2011. With net profit margins again declining for a third year in a row. And a very important metric is EBITDA in comparison to cash flow from operation. If we look at our graph over here, we can see that blue line, which is EBITDA, is outpacing the cash flow from operation in red. And that is especially true in the last few years, as we can see the gap had widened considerably in 2024 and 2025. This is something we don't want to see, but in this case it actually makes a lot of sense, and we have explanation for this growing gap. And this is that Novo Nordisk is expanding, building new facilities, putting a lot of cash and effort into expanding drug manufacturing to meet demand. So that means that cash flow is actually not reaching their bank account as of yet. So this is not exactly a red flag yet, but if this trend continues, then means that the company has a problem with collecting cash from the investment it had made. So this is something we have to keep an eye on for the near future. CapEx being at almost 1/5 of the company's revenue is huge, but again, this means that Novo Nordisk is putting more money into facilities to meet the demand for their drugs. And because of declining cash flow from operations net margins and expanding CapEx, the free cash flow margin sits at only 19%, which is the lowest margin from all the history we have here, so from 2010 till today. With shares outstanding again decreasing at very modest rate of 0.3%, while dividends paid increased for 28%, with dividend payout actually surpassing 50%. Now before we go into future projections, let's quickly look at another very important metric, which is residual cash from primary business. And this metric is very important because it shows us how much cash is actually left for the owners. And I'd like to point out that in previous video I made a mistake because deferred income taxes were actually left in Danish krona and they're not swapped for American dollars like other numbers we have over here. And also remember, because of this exchange from Danish krona to USD, we might have a slightly different numbers. But okay, back to residual cash, which is calculated by taking net income, depreciation and amortization, deferred income taxes. We sum everything of this together, and from this number over here we subtract out capex and common and preferred dividends. And what this gives us is a residual cash from primary business, which for Novo Nordisk is positive from 2020 to 2025. With actually 2025 having the lowest number recorded at just 635 million. Now from this we can also calculate stock price, and if we adjust for debt and cash we get just shy of $10. And this is not our buying price, but this is what is company worth if we strip away everything but its main business, and what actually owner will get if they will take all the cash from the business. And over here we can also calculate free cash flow, which is calculated a little bit differently than from the one above, so it is just slightly different. And from it we can also calculate stock price, which comes in at 32.3. And this is actually much closer to the actual stock buying price. But remember that both of these metrics are looking into the past. So what the company is worth today based on the past numbers. But we know that Novo Nordisk is growing, so that's why we have to look into future projections to see what might be worth, let's say 3 years, 5 years or 10 years from now. Now before we move into future projections, we can also look at a dividend ratio. And this tells us how well the dividend is covered. If it's above 1.5, it means that it is safe. If it is between 1 and 1.5 we have to watch because they're approaching a limit where they will need to borrow cash, because if this ratio falls below 1, then this means that the company needs to take cash from their bank account or debt to fund dividends. And with Novo Nordisk we are currently sitting at 1.08, which means we have to watch closely, and if you are considering Novo Nordisk because of the dividend, you maybe want to reconsider if it is a smart play. Before moving to future projections, remember that this is not financial advice. Do your own research before buying any stock. Now let's look at future projections. Here on the right we have analysts' numbers in orange, while in these rectangles we have our own projection. Novo Nordisk is guiding for a revenue decline between 5 and 13%. So for 2026 I put 13% decline, which takes us back to $42.5 billion in revenue, with 5% drop gives us a $46.5 billion in revenue, and for our average I just took the number in between. For 2027 and 28 I put 1% growth for our minimum, 3% for our average, and 5% for our highest assumptions. I took these numbers to be conservative because all of the competition in the market. While analysts are expecting that Novo Nordisk will grow its revenue for 2027 and 2028 at 5%. So here we are very conservative. For net income, I was also very conservative, putting a profit margin between 30 and 32%, and with EBITDA again I was very conservative, putting 42%, 45 and 48. Just keep in mind that in the 2025 EBITDA was at 49. What we can see here are only 2 red cells, meaning we are still very conservative, as only 2 of our numbers are bigger than analysts' numbers. Moving on to cash flow from operations, what we do here is simply taking EBITDA numbers and multiplying it with 85%, which is how much of EBITDA actually goes into cash flow from operations. Now moving on to CapEx, here for 2026 I manually put in negative $8 billion, while for 2027 and 2028 I put in that it will take 10% of revenue. Now what we can do, we can calculate free cash flow by subtracting capex from cash flow from operations. And what we get here is that free cash flow that is on our highest assumption is a bit higher than analysts' expectations. Now before we calculate our first stock price, we need to discount this free cash flow to today. And to do that, we simply take our discount factor and for each year we discount it to today. And doing the same for terminal value, which is calculated based on discount factor and perpetual growth rate, which is at 2.5%. Now that we have our free cash flow discounted back to today, we can sum everything together, so free cash flow from 2026 to 2028 and terminal value to get our present value in our perpetual growth rate model. Now to be even more precise, what we do is take our present value and subtract out debt and add in cash. And because Novo Nordisk has quite more debt than cash, the new value is lower than our present value. And from it we can calculate our stock price, which ranges from $30 on the lower end to almost $45 on higher end, with analyst numbers coming in at 41. Now our second valuation is EBITDA multiple, and here we take 2 multiples. One is based on industry average, which for drug manufacturers is sitting at 15.75, and from Novo Nordisk's own history the EBITDA multiple is at 17.35. What we do here is simply take EBITDA numbers in 2028 and multiply it with the company in industry average to get our terminal value in 2028. Again, we need to discount this terminal value back to today. Now to get our stock price, we again subtract out debt and add in cash, and this gives us a company average of $55 all the way to $75, and with industry average being at $50 all the way to $68, with analyst numbers coming in at $75 and $68. And now what we do is take our perpetual growth rate and EBITDA multiple and average them together to get our company average range, which ranges from $38 all the way to $54, and industry average range, which ranges from $36 all the way to $51, with analyst numbers coming from $52 and $49. these are our estimates, and before I give you my buying price, let's see again which boxes Novo Nordisk actually ticks. So based on long-term average, Novo Nordisk is growing at 10%, which is amazing. EBITDA and cash flow from operation growth matches, which means good accounting, with the exception to the last 2 years. Last debt and average debt to EBITDA are below 3, which means that they have room to take more debt. Shares outstanding are going down, with 1.6% being a long-term average, and residual cash from primary business is positive, which again points to very good business. Dividend yield is at 3.8%, with dividend growth being at 15% over long term, and last dividend payout is at 50%. With all of this in mind, I believe Novo Nordisk is a great business to own. That is why I bought some additional stock with the latest pullback, as I believe our average assumptions are achievable. That's why I set my buying price at $47.50, which is slightly below the price from previous video. If you like this kind of analysis, please consider liking and subscribing, as it would mean a lot. And please let me know down in the comments below your take on Novo Nordisk stock, and which one I should cover next. See you in the next video. Bye bye.